Hey, Alpha fam, welcome back to another episode of Alpha Commission. Today on Alpha Commission, of course, we are celebrating CPI Day, which, of course, is a measure of inflation, which is preceding the Federal Reserve's decision on the 21st regarding raising interest rates. Now, what I want to do this episode is effectively go over a thought problem, just to go over the possible risk that we may have in facing CPI data today. So, one of the things that I think is important to point out is that last time we had a CPI report, there was basically zero increase, right? There was basically just a nominal increase in inflation in our last inflation report. And so the market really is expecting that as a baseline. If we go over to Market Watch, we can see that last time we had 0%. And then the expectation is actually to decrease by 0.1% in consumer price index, the general inflation, right? They might, be pricing in some type of a small increase, just year over year and month over month, right? But in general, the CPI should be coming in at zero or negative in order to meet the market's expectation for this bullishness that we've been seeing in the charts. So, just as a thought problem, if the CPI itself comes in at just 0%, there's no inflation, then that's going to be negative for markets. Okay? If there's any bit of inflation whatsoever, it's going to be negative for markets. And of course, if we have better than negative 0.1% consumer price index CPI data, then that would be good for the markets, right? So just keep that in mind. The number to beat is basically 0% inflation. And I'm just putting this out as a thought problem. Is that realistic? Is that realistic? We had a nice, dump in inflation in August, and so of course we got a nice pump in the charts. People are saying, okay, inflation is kind of rounding. It's maybe turning around. Maybe we're having peak inflation. But can we really say, that inflation is 0%, right? The year over year doesn't really matter because that's too much amount of time. We're talking about decisions being made in the next month. We're talking about decisions being made in the next couple weeks. We're talking about how price is going to behave, you know, tomorrow or during the Ethereum merge or during the Federal Reserve making their decision, right? So year over year doesn't really matter to us too much, okay? Yeah, I mean, we don't want to see these numbers going up significantly, but if this was 8.1 instead of 8, that's not going to kill us because 8.5 was the last measure. So we actually have a buffer room for the year over the year. And the core CPI expectation is actually to go up a little bit. That's what's expected on the year over year. So we have a little bit of buffer room here. If this is 6.1% or something like that, as long as it's in the low sixes, I don't think it's going to really affect anybody because they're thinking, okay, well, this is encompassing, the whole last year. So, there was a lot of inflation in the last year. So it's okay if these numbers are a little bit, off. Like that's not going to shake the market too much. They won't like it, but it's not going to shake the market. But if we get a core CPI rate that's higher than 0.3%, which was pretty low, okay? It was pretty low. And a CPI that's greater than a negative 0.1%, which means no inflation, that's going to be bad for markets. So just from a risk assessment point of view, if you're following my logic here, it's better to make sure that when you wake up, when you watch this video, you just protect your positions, right? We can be bullish and at the same time protect our positions. In my last video, I was talking about how we're likely to have pullbacks, right? We're likely to have bullish pullbacks, and I still believe that's the case. But we can't underscore how much a negative CPI, the negative number is actually what we want, but what a bad CPI number could actually do to the market in terms of just scaring them for the day. Now, why do I think that this is just going to result in a bullish pullback? No matter what it is, if the numbers are a little bit scary, we're probably going to get a pullback. But why do I think that it's probably going to retain some bullishness to it? Well, the underlying data behind my intuition on that is that we already have basically 91%, 88% of the market considering 300 to 325 as the target rate for the Fed, right? We only have 12%, right? We have approximately 10%. Only 10% is considering that the Fed is going to go weak in the next, interest rate increase on September 21st. So just follow that logic, okay? Follow that logic. Previously, it was 50-50. It's 50-50, right? So if we had bad CPI data, right, it not only would shake the market, but it would likely kick our legs out from underneath us. Why? Because half of the population of traders, effectively, were thinking that the Fed was going to go easy on us. And so bad CPI data would suggest that the Fed would go hard on us. And so half of that would not have been priced in. And so we would have been just pounded in the market. But today, a month of the Fed, the chairman and the board members of the Fed coming out like day after day after day, just being super bearish, super draconian in how they talk about interest rates. Everyone believes them. Now we basically have 91%, 88%, right? A solid 90%, let's say, of the market has priced in some type of draconian actions by the Fed. Right? So let's go back to our CPI data. So if we have bad numbers, okay, if we have bad numbers in the CPI, that only mattered as long as half the market was really Pollyanna-ish, right? We're just completely ignorant of the potential for the Fed to increase interest rates. But almost everybody thinks the Fed is going to increase interest rates. And so there's only a 10% hit that we could take in terms of whatever the drop was going to be. Assuming that the Fed meets the expectation of that 75 basis point increase, which the market pretty much expects now. And so what can really knock us on our butt is only if the Fed does 100 basis points or something crazy. In other words, this CPI data has to be way, 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 way out there for the Fed to do something like 100 basis points, because 75 basis points is already effectively priced in because the market believes what the Fed has been telling it for the last month. And so I believe there's a stability in this, okay? There's a stability, but there is the potential for a pullback because we still have 10% of the market not pricing in what the Fed is basically telling us it's going to do, right? I mean, they haven't said 75 basis points, So we don't know that. It could be 100 basis points. I doubt it. It could be. We'll find out on the 21st. But let's just say that the market is right in 75 basis points. Then only 10% of traders out there, right, are going to get it wrong. And so we're going to have a pullback if we have bad CPI data. But we're not going to drop to hell. Okay, we're not going to drop to hell. The thing that can drop us to hell is if the Fed increases interest rates by 100 basis points. The thing that can drop us to hell is if this number is just incredibly bad. Incredibly bad. Like it has to erase all of the bullishness of August. The number has to be really, really bad. Okay? But the trend looks pretty good. The trend looks pretty pretty good. And so even if we have a bigger number, than what we want, most likely we're just going to have a bullish pullback. That's my assessment. That's my risk assessment on this based upon a thought problem of where we stand right now. I couldn't have said that last month because only 50% of the market had priced in the potential for 75 basis points increase. The majority of the market almost was thinking that it was only going to be 50 basis points and that the Fed would have pivoted at that moment. That's why we got that super bull run, right? Because the market was basically filled with idiots. Okay? That's why we had a bull run. That's why we had a summer relief rally, a summer bull run when the bull market was not ready, right? We're still in a bear market, but they're having bull runs, right? So the Fed was like, chill out. We're actually going to keep smacking you down. So we came down a bit. Waited another couple months, right? We're just kind of filling it out. Seeing how inflation goes. Being a little bit more realistic. Not extending as much credit, right? Being a little bit more responsible, these businesses. And so, yeah, we can get smacked down again, but it looks like we have the potential for a local floor in the markets. Let's jump over to stocks to just take a look, right? Just to take a look at what's going on here. First of all, on the daily, I don't see any drives of a MACD, bearish divergence over here. We have a ton of MACD divergence, bearish divergence on the daily on these run-ups. I don't see anything over here, okay? You have a couple drives of bullish divergence, actually, over the last couple months building up. Okay. Looking at the same time frame, nothing terrible going here on the daily. I don't think the 4-hour really works for the stock market, but we could be extended. We could be overextended. Maybe we could have some type of a pullback, right? Maybe these kind of cycles, right? These kind of cycles, we're jumping up a little bit fast. We're moving a little bit impulsively over this last month, right? September. We're moving a bit impulsively. We could get smacked down. But is it enough to break our floor to just get smacked down? That's what I'm asking. And I just don't think so. I just don't think so. I don't think based upon the CPI data that we're going to break our floor, okay, that we're kind of putting in here. Yeah, we've got some red flags going on. A little bit toppy on Stokes on the 4-hour, right? A little bit toppy on some of these indicators. Got some nice surrounding on the 4-hour MACD here. A little bit toppy on the RSI. A little bit toppy on the ADX here. And so, sure, we could get a pullback. Why not? Yeah, we could get a pullback. The question we're going to have to ask ourselves is how far are we going to go down, though, right? How far are we going to go down? Again, this is S&P. And just to give you a sense of the scale, this is the top of the market up here, right? So sure, I mean, maybe we could even come down to our lows if it just happens to be really bad. But are we gonna breach this and make a lower low? I just don't feel the CPI data carries that kind of risk today, guys. So protect your positions. 10% of the market is maybe acting a little bit irrationally, but the majority of the market seems pretty well to understand what's going on. And at least in the continuous contracts here, right? The futures anyway, we've got some nice bullishness on the charts. This breakout, it wasn't, I suggested maybe it was just exuberance, right? Just kind of poking through here. But no, we used that diagonal as support. The diagonal that I drew out for you guys, we used it perfectly as support. See, I've got my circle here, right? We used it perfectly as support and then launched off of it and then built up little baby support here, and we're still launching. We're going as we speak. The market is open on these futures. And so we're reclaiming this candle. You see this candle getting filled up here? And so maybe we do have a zone, right, where we could get some toppiness, get a rejection. I have this point over here. This is not significant. The location is not significant. Just the movement is what I'm trying to get at. Like what I was projecting when we were back here was just that we would break through this line and then move up here. And then the bearish outcome was if we just poked out and then got deflected down. But we didn't get deflected down, right? We broke out, right? And so we're still going. And so we have kind of a natural limit up here. We also have a couple lines right here. We have a little line right here that could reject us. Around 4180-ish, right? Or 4185-ish. And then see if we come down. And then we have a CME gap. Basically, if you extend this diagonal down, like we could come all the way down here and fill our CME gap, scare the heck out of the market, and then continue to go bullishly. And we wouldn't violate our MACD, right? Our MACD continuation on the daily. And if we turned around, these things would stay, these momentum lines would stay pretty much in the same area. And so I have no problem with us coming back to 4,000 on the S&P 500. Let's take a look. Let's take a look at our EMAs. Yeah, look at that. The 21 EMA is right there. The 200 EMA is right there at 4,050, right? It's 4,050. Not such a big deal, right? I mean, we could wick as long as we don't close the day too solidly under there, right? As long as we were able to pump out of this somehow, I would prefer to bounce off this green zone. That's why I have this green zone, right? Because I want to maintain that kind of bullishness on the weekly. I want to maintain that weekly 9, maintain that weekly 4, maintain that weekly 21, which we are nicely over right now. And so if we just fill in the CME gap some other day, that'd be fine by me. Maybe the Fed really does something to the market, right? But we could wick down into this area and still have our daily momentum going, even though we would have to have we would put up some pretty big fights with our EMAs on the pardon me, you know what? This is the 4 hour. Okay, that's the 4 hour. Let me double check with the daily because I was wondering why is that so bearish? That was my mistake, guys. Sorry, it's on the wrong time frame. Yeah, look, our tens, right, are down here by the CME gap. Okay, that makes much more sense. Man, I was really being thrown off there. I was gonna say, man, wow, this was the first time I was going to disagree with my EMAs. And I was like, what the heck is going on? So, in general, the EMAs do recommend that 4,500 as kind of a bottom line for a bounce, right? But as you can see by the 10 MA, like we can wick into that area of 4,000, and the 10 MA is still going to be there for us. Now we have the 200 EMA overhead, and maybe this could be one of those catalysts along with that resistance line up here, right? That could knock us down, if we do have a pullback today. right? So you get my point, okay? My mind is buzzing with different things of what could go wrong, what could go right, what could go wrong. And I would want to bounce off of this green area, right? The ideal circumstance for me is to bounce off of this green area. I wish we had filled that CME gap while we were down there. That would be better for bullishness in the long run. Because now this is like an open wound that we have to fill someday. And so we could wick down there and then bounce bullishly. You're threatening your EMAs, right? You're threatening your EMA structure. You're threatening your market structure pretty severely. That could be a great way to liquidate people, to be honest. Just freak them out and then bounce up, right? Because we're maintaining our momentum on those dailies. And then just quickly recover our weekly momentum and just continue to go. That's possible. Or we just forget this CME gap and just come back to it some other day, right? Sometimes we leave CME gaps and they just, get back to it a month or two later or something, right? Again, if we just continue to drop, if we go lower than that area, if we go lower than 4,000, then probably we're going to test the bottom of the range. At 3,900 on the S&P 500, we're going to be, mini futures, we're going to be losing our daily momentum. And then most likely we're going to be heading towards this 3,800, which kind of has a diagonal support for us. And if we lose that, it's game over. Okay, so that's why I say 3,800 is kind of our game over line. The line in the sand is down here at 3,900. Just a double bottom, right? Kind of scary, but you could double bottom, and then you have this kind of fake out zone with the CME still in that momentum area, no problem. Stressing your EMAs, but could still go for it. And then ideally, you don't get lower than 4,080, right? 4,050 on S&P 500 mini futures. And that can kind of give you an indication of the relative stress that we're under, right? If I describe it that way for you guys, I hope that made sense. The NASDAQ, pretty much the same thing going on here. We have that same CME gap right there, right at the top of our daily momentum zone. We break under that, we're really threatening to break things. You break below the momentum zone, most likely you're just plummeting to hell, okay? Right, so for NASDAQ, right, the NAS 100 futures, that's about 12,000, okay? 12,010, something like that. It's kind of your line in the sand there. And the CME gap around 12,400, let's say. And then ideally, you don't break down below, 12,700-ish. That would be ideal. So there's your levels for the NAS 100 for the NASDAQ, okay, futures. That's kind of your key, guys. You understand what's going on in the market if you can just take a look at stocks, right? Because stocks really are sensitive to these things right now. And the S&P 500 is being, very sensitive to it. So, NASDAQ is more correlated with Bitcoin. You can take your pick. You can take your pick. Now for Bitcoin, we have something interesting. I told you we have all these CME gaps to the upside. We have a couple of them. People often forget this one up at 35, right? Which makes my hypothesis of a possible squeeze play to the upside, right? Just a monumental one based upon this broadening wedge, even more enticing. Let's say that this broadening descending wedge does play out. Just hopium on my part right now. This thing has not been validated yet. This has not been validated, guys, okay? I mean, if we could push through that, I mean, it's not. It wouldn't necessarily even stop there. I mean, there could be a chance to just wick up and fill that second CME gap, or maybe that one's left for later. You know, maybe just have a little run and then get rejected. I don't know, but the target move is somewhere around 30 to 32,000 bucks, assuming that this actually plays out. We have our diagonals here. See that? Let me turn off this wedge. We have these diagonals. And you can see how we popped through it, claimed it as support perfectly claimed it as support. Boing, right? And are breaking down, retesting it, boing, finding it as support. We don't have significant amounts of high level bearish divergence or anything here, okay? This isn't looking that trappy, okay? This is looking like a squeeze to the upside. There's a falling wedge with a measured move in this area. There's a broadening descending wedge with a measured move to this area. Boom. That would be insane. This could take weeks to play out. It could take months to play out. This is a huge amount of time, right, where this wedge is being formed. This could take a long time to play out. I'm not saying this would happen overnight. I'm not saying this is what would happen on CPI day. I'm just saying that we are building a structure with the potential to move to 30K. Assuming that we don't break anything while we're down here, and if we can end up confirming some support. What would be a bottom line in the sand for me, right? To confirm. Well, let's see, where's that support and resistance? There we go. Well, what if that falling wedge, right? The measured move takes us into this area, right? But we have a pullback first. And what if we end up basically making a head and shoulders right here, an inverse head and shoulders, like this, with a measured move above 25,000. Well, if we do have a pullback and we get above 25,000, I have no idea why anyone would be bearish. This is the measured move of the inverted head and shoulders. I don't see anyone talking about this. There's a potential pattern here. Coming off a falling wedge that's basically being played out. All right? And if we have just a bullish pullback, we're going to make a right shoulder with a measured move to 25,000, over 25,000. And then that is going to take out this local high, and that is going to be a higher low and a higher high. That's going to be an uptrend. And if we have an uptrend, then why couldn't this broadening descending wedge play out to 32,000? And if we play out to 32,000 and capture that zone, right? We can get rejected there. But if we capture that zone, which is directly overhead, then we could perhaps even play in this next area above 30,000. And some of you guys might just get shocked Might just get shocked and awed at what's possible in a bear market. Don't be a perma bear. Don't be a perma bull, but don't be a perma bear. Just be a clever little alpha monkey. Think the way that I'm thinking about these things. Challenge yourself to think in a different way. Don't just listen to people. Don't just regurgitate what other people are saying on YouTube as if that's your idea. These aren't your ideas. Make your own ideas. Come to your conclusions. Think. Think for yourself. Right? And we have a downward trend line right here as part of that broadening descending wedge. So it makes sense. It makes sense that we get reflected in this area. All right? It makes sense that we get reflected in this area. Oops. What did I just move? And if we get reflected in this area right there, right? There's a little bit of a diagonal support here. I mean resistance here. Look at that. Look at that. See this? See this? See this? See these ones using it as resistance? Support right here. Support right here. Right? Support right here. Resistance right here. It's using it as resistance again, and then it's meeting this downward slope right here. Resistance, 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 resistance. Rejection. If we don't break below 20,000, what was that number I gave you last episode? 20,800. If we don't break below, if we don't close a candle body below 20,800, right? That's the number. 20,800. If we don't close a candle body below 20,800, we're going to have made another shoulder on this formation. This side's going to be very sloppy. This is going to be a very janky head and shoulders, but we're just looking for the price action. We're not looking for beautiful constructions. We're not looking for patterns. We're looking for price action. And the price action will retain bullishness not only by the daily MACD continuation, but also by the daily Stokes, and I might add the weekly Stokes. Plus, we will have preserved this potential for weekly bullishness by holding above or in the vicinity of the weekly 4 and that potential for squeeze play with the weekly 9, which could then get us to this next area. And assuming that that head and shoulders plays out to the upside and that rising wedge, or pardon me, that falling wedge continues to have momentum to the upside, and assuming this broadening descending wedge, assuming that all these pattern traders are seeing what I'm seeing, assuming that stocks are holding on to those key levels that I showed you, there's going to be a lot of interest to the upside, at least to that 25,000. And then we can potentially see a lot of shorters get stuck just like they got stuck right here if this thing just blazes through there and fills the CME gap. Recovers this institutional candle, right? I don't know. Maybe it could get knocked down and then retest this pattern and then, try again. It could take months. Maybe the Fed knocks us down. And so this doesn't last that long, right? Maybe it's not just all up in one candle. I'm not saying all up in one candle. I'm just giving you possibilities. But this begs the question, right? This begs the question. What could happen with the Fed? Everybody has already priced in 75 basis points as an increase. We can see that 88% and 90% of the market has already priced in what the Fed is going to do. And so we only have 10% of the market full of idiots, right? at this time, because the Fed has been so vocal about what they're going to do, that there's only a little bit that we could get knocked down if the Fed does, in fact, fulfill their promise and do something harsh like 75 basis points. Guys, we are going to go screaming to the upside. We are going to go flying to the upside if the Fed only increases 50 basis points. But if they do 75 basis points, as is most likely and as most the market is pricing in, it's not going to deviate our path that much, right? So what is going to knock us on our butt is if the Fed increases by 100 basis points, if the CPI data is just incredibly terrible, right? Not just a point off, a couple points off, but it has to be really terrible. Because the market is already pricing in basically the worst case scenario from the Fed. And so unless the Fed is willing to do 100 basis points increase, what else could happen? Right? What else could happen? Oh, I guess we could say that, maybe, going into the new year, maybe they increase another 75 basis points, but that's months away. Plenty of time to look at other CPI data, other PCE data. This CPI data isn't going to have that much of an effect on those future CPI data reports. We're going to be looking at those future CPI data reports. And so what we're talking about is not like year over year, not like quarterly. We're talking about just this month. And so that's the thought problem that I started this episode with. So what is this, a short squeeze? Right? Are we're just going to destroy, all the bears? Is this bear hunting season? Just food for thought. Just food for thought. Watch those key levels. And for Bitcoin, again, pardon me, I keep pausing because I'm coughing and I'm muting while I cough. Still not 100% better yet, so still have been sick for quite a long time, months. Still recovering, guys. Let's see here. 20,800. That's the number to beat, guys. We don't want to break down from there. We don't have any reason to go back down to these levels. If we've reclaimed this level, right? If we've reclaimed this level, we don't have any reason to come back down here. If we do, then we're exploring the bottom of the range again, right? Maybe even making a new low, right? That's going to be the rejection. That's going to be that Wyckoff pattern that I was pointing out up here, right? Where we got rejected. But we broke above the diagonal. And then we even have tested it already. I mean, we can test it again and fill in this CME gap, kind of a deeper retest, kind of a deeper pullback, right? But we don't want to be breaking 20,800. No, no, no. We don't want to do that. We want to retain our weekly stoke. We want to retain our daily MACD momentum to the upside. We don't want to retrace this candle. We can retrace this candle later on, okay? Like after this move fails or whatever, wherever it gets rejected from, we can talk about that stuff later, right? Let's get a little run first. It is possible though. It is possible. Let's take a look. Let's take a look at Ethereum. Ethereum getting a little support here. Oh, sorry. Before we move on from Bitcoin, I just want to point out something that I noticed. Just I know We don't have a significant amount of bearish divergence on the MACD here, but the RSI looks pretty clean. It's just really impulsive. But I did notice on the 2-hour, wow, multiple drives of bearish divergence in the bullish control zone, which suggests to me a pullback is needed. Okay, like that suggests to me that a pullback is needed. Now, we also have these bullish drives, but and that's the contradiction of this impulsive kind of move, right? But these bearish drives in the bullish control zone have a little bit of preference, right? Get a little bit of preferential treatment because of how overextended we are. Where it's hard to just consider that you can just keep going up in a straight line forever, right? Which these other drives would suggest. It starts to make sense that you could potentially start, rolling over a bit, maybe doing a bullish pullback or something, right? Sort of like here. You see this? All these drives, you have 3 drives of a bearish divergence, you have 3 drives of bullish divergence, kind of in the bullish control zone. The bears win, right? The bears won there. Same thing here. Same thing here. Many drives of bearish divergence, many drives of bullish divergence. In the bullish control zone, the bears won. Okay, it just tends to happen that way. Bearish divergence, bullish divergence in the bearish control zone, bulls won, right? It's kind of like tipping the balance. It's just finding a little bit of an equilibrium. So I do give a little extra weight to this, to these many drives of bearish divergence up here. Okay, just what I noticed tends to work out. And so a pullback isn't unreasonable. That's why last episode I was talking about the likelihood of pullbacks, right? Watch out for pullbacks. That's what the title of the episode read on the image, right? The thumbnail. It said, bullish, watch out for pullbacks, okay? And so if we jump to some of our coins, you can see pullback. But is there anything bearish about this, right? Let's go to the daily. Here's Kadena. Pullback, but we're still above our diagonal, well above our daily momentum. Flux, pullback. This thing's burnt out, okay? This thing just went crazy, right? This thing's burnt out, so we're going to have to watch Flux. It is breaking below its daily momentum, but its daily momentum was basically at the top of its price action. So we should expect that this thing's kind of rolling over now, right? It burnt out itself. Just give it some time to heal, right? ADA, bullish pullback, preserving its daily momentum, but a pullback, right? Zilliqa, this actually looks not too bad. I mean, it's lots of wicks, but, above its daily momentum, kind of rounding, right? It could pull back, but, this is just a bullish pullback, if so. CRV, trying to hang on. We talked about CRV, trying to hang on. It's at resistance, guys. It's at resistance, okay? Like we talked about this. There's a huge distance down to support. It already made this move, right? It made this move. This is where you took your money, right? Everyone took their profit. And then look, it's just bullishly pulling back. It's trying to find support in this mid-channel area, right? This is the channel, this length right here, this channel, right? You see it just crossed the channel. It dropped from the channel, it crossed the channel again. And it's literally like struggling to hold on at resistance. So this is a very strong attempt by CRV. Like we should be proud of what CRV is doing. It's doing its best, okay, guys? I mean, we want to kind of see it above this 128. If you didn't get in, on this formation or, at support on it, at one of these kind of like daily levels, then, you know, it's a risky play unless you have your stop loss nice and tight. But, it'd be better to be at 128 or, so that you can play with this range up here and you're buying in at support. But it's okay. You can think about this stuff. It's trying to hang on, right? So good job, CRV, right? It's trying its best. Let me throw on the EMAs on CRV. Yeah, it's trying its best. Closed the daily under the 10, right? Under the 9. So squeezing to the downside, but still hanging in there. So, doing its best. You want to see it above that 9. You want to see it above that 4 EMA, okay, on the daily. Closed candles above there. Right? Sort of like what it was doing up here. But it met resistance, guys. That's why this is a red zone. It met resistance. It got rejected. You take your profit there. If you bought in here on this wedge, right? You had a higher low, a higher low. You can buy in on here on support, right? Above 105. Ride it up to the next level, right? Whatever you want to do. If it just keeps going, it keeps going. And then here's the major resistance zone, and then you just know to take profit in that area because we got another major resistance zone. What do you expect is going to happen? It's going to pull back, right? It's just pulling back. Guys, the dollar, the dollar is breaking down. We've been talking about this. The dollar is breaking down. It's pushing through this diagonal. All right, we hope to see this continue. This doesn't look like it's just going to turn around on a dime. I mean, it could with a bad report, but it looks like it wants to push down a little bit more or go sideways. There could be an engulfing candle, gets us back up here, kind of terrify people. I could see that. All right. You see this candle right here? We could do something like that. All right. Just kind of boom, boom, kind of sideways, go down again, and then maybe Jerome Powell like freaks us out. Then we kind of round out again and go down a little bit more, right? So this could be choppy. This could be volatile. This could be bad for markets. This could be uncomfortable for markets. We could be having those pullbacks, guys, right? The dollar is going to be overall bullish. I still think it can reach 114 and that it has the ability to get to 118, but I think 114 is pretty reasonable. I'm still long-term bullish on the dollar. But can we have an era of it pulling back? Heck yeah, and that could be great for a mid-cycle trade. USDT dominance finding support on my support line over here. I really haven't had to change anything. This thing has just been playing every single level that I've marked out just beautifully. Finding support there. A little bit of indecision. If we bounce back up to this kind of midline area, then yeah, that could be pullbacks on the charts, right? Pullbacks on the charts. VIX. Same thing. Same thing. We have a CME gap down here that it just refuses to fill. If it drops down, fills that one, it could bounce back up. All right. Lots of volatility in the market. We don't know how the VIX is going to go. Right now, we're in a pretty good trading zone. Okay? So, not too worried about the VIX right now. Just if it starts bridging this gap, I just get a bit worried, okay? It starts feeling uncomfortable for stocks if we bridge this gap in the middle here. But as long as we're just kind of swimming in this area to the side, right? Or down or to the side, it's just going to feel fine for stocks trading, right? And we're just kind of going down and to the side right now, right? But we could get a bounce. You can see this diagonal. We could get a little bounce in this area, right? Maybe get wedged in here, something like that. Could be little pullbacks in the chart, right? So there's that risk. There's that risk for pullbacks. All right, guys, just wanted to do an assessment of the CPI data coming out today. Wanted to just give you a heads up on my theory of the market based upon the Fed and CPI. Take a look at some of those risk factors. Take a look at what kind of pullbacks we might be looking at under those circumstances. It's really impossible to say, but there's no precision in this. But I'm trying to do my best to bring some data and some ideas there. Let's see. We do have pre-markets opening, but there's no trades, so I can't give you a heads up on how the market is moving. We just have to use the continuous contracts here with the futures. And we're just kind of meeting some resistance there, right? So we'll find out. We'll find out tomorrow. There's your alpha for the day. Stay safe on this CPI day, and happy trading.